They trade on marginal change. If the US is getting worse faster than the alternatives, the dollar can fall even if everyone else is a mess too. That's the trap people miss. Here's a simple example. Imagine two runners. One is already ahead, but he twists an ankle. The other guy is exhausted too, but his ankle is fine. In that moment, the lead can shrink fast. That's what a currency move can look like. Not a moral judgment, just a shifting handicap. And right now, the US handicap is being shaped by three forces at once. First, the rate path. Markets don't wait for official cuts. They price them in. When traders start believing easier money is the default next step, the dollar loses one of its biggest supports, yield advantage. Second, the funding need. When you have to roll and refinance mountains of debt, you're constantly in the market asking for buyers. And if buyers demand a higher return to show up, the system either pays that return or finds a workaround. And the most common workaround is a softer currency. Third, the confidence premium. The dollar has been able to borrow cheaply for decades, partly because the world trusted the rulebook. When investors start asking questions about policy stability, fiscal discipline, and what happens in the next crisis, that premium gets shaved down. Now, none of this is a doomsday prophecy. It's a pressure gauge. And when the gauge rises, metals usually react before the headlines do. Also, let's be honest about what a lot of people are feeling but won't say. They're tired. Tired of official narratives that change every quarter. Tired of being told inflation is transitory, then sticky, then solved. Tired of being told debt doesn't matter, right up until it suddenly matters. That emotional fatigue is part of the setup too, because when trust wears down, people stop giving the benefit of the doubt. And that's when a small technical break turns into a trend. So keep that in mind as we rewind, because the history lesson isn't about nostalgia. It's about pattern recognition with real money on the line. Because the next few minutes are going to decide whether the move you're seeing in gold and silver is just the warm-up or the start of a full-on repricing that catches most people flat-footed. In the last video, I laid out one simple rule. The precious metals don't put in a real, durable top until the dollar breaks down in a real, durable way. Not a cute little dip, not a one-day wobble, a breakdown that changes behavior. And for months, this market has been obsessed with one number on the dollar index, 96. That level has been tested and respected like a steel beam. Tap it once, bounce. Tap it twice, bounce. Tap it a third time, and you start hearing that cracking sound nobody wants to admit is real. Then yesterday, January 28th, we finally slipped under it intraday. And even with the central bank doing its whole "we're watching the data" performance, the dollar didn't look strong. It looked tired. Here's what matters. The dollar index doesn't have to collapse overnight for gold and silver to move like rockets. It just has to lose credibility in slow motion. The kind of slow motion where people keep saying, "It's not that bad," right up until the day it is. And based on recently published numbers and recent market updates, you can see the same pressure building in multiple places at the same time. Debt auctions, rate expectations, and global capital flows that don't care about patriotic speeches. That's why in this video I'm going to do three things in order. First, I'm going to walk you through what happened the last time the dollar index fell from this exact neighborhood, and what gold and silver did while it happened. Second, I'm going to show you what might come after the next support zone, because that's the part nobody wants to talk about out loud. And third, I'm going to address the question I keep getting hammered with. If silver is exploding, do you buy the metal or do you buy the miners? And I'm going to be brutally honest about the upside and the landmines. Before we jump in, check the description. I tucked bonus links down there, including a premium WhatsApp channel link and a channel membership join link. If you want the quick updates and the behind-the-scenes notes without hunting for them, it's right there. All right, let's get into the part the everything is fine crowd hates. Even if you ignore politics, personalities, and headlines, the math is getting loud. The federal debt is now north of $38 trillion, updated basically in real time. And when you stack that on top of refinancing needs, the interest bill, and the fact that buyers are getting pickier, the system becomes more sensitive to small shifts in confidence. So when the central bank speaks and the market hears cuts are coming, that's not just a rate story. That's a currency story. Because currencies trade on relative pain. If the US is moving toward easier money while the rest of the world is trying to stabilize, the dollar loses its edge. Now, some people heard the latest press conference and took away one message. They're going to cut. Others took away a different message. They can't really do anything else. And that second message is the one that tends to push people into hard assets. At the exact same time, global investors have been rotating in ways that don't show up on your daily news scroll. You can see it in fund flows. You can see it in the way the dollar index reacts to decent data and still can't hold a bounce. You can see it in how quickly gold is being bought on dips. And you can see it in silver, which has been acting like a market with a tight supply chain and a nervous crowd.
Silver just pushed above $100 an ounce, printed an all-time high north of 117, and then snapped back hard. That kind of move makes people emotional. Bulls start doing victory laps, bears start screaming top, and everyone forgets the only question that matters. What's the trend under the noise? Here's the key relationship that keeps showing up, decade after decade. Gold and the dollar index tend to melody after the fake bounces failed, and after people stopped waiting for a quick snapback. That's why a break under 96 matters so much today. The first move grabs attention. The follow-through is what changes portfolios. And when you see silver pause, then rip, that's often forced positioning, not the end of the story. It's the difference between a spike and a cycle. And cycles can run longer than anyone expects, quietly. The dollar index was hanging around 96 and then slid down toward 90 over a matter of months. That was a meaningful move, not because 96 is magical, but because it was a signal. The market was willing to price the dollar lower for an extended stretch. And during that stretch, gold didn't politely drift. It stepped higher. Silver didn't tiptoe. It surged. Now, I'm not saying history copies and past performance guarantees anything. What I am saying is that markets rhyme, and when the same setup appears, you pay attention. If the dollar index repeats a move from the mid-90s down toward 90, and if metals respond with anything close to what we've seen before during similar currency slides, then the next leg in gold and silver is not a fantasy. It's a scenario. Think about it like this. If gold adds a modest 10% from current levels during that kind of dollar drop, you're suddenly staring at prices that sound crazy to people who stopped paying attention years ago. And silver, because it's smaller and thinner and more emotional, can move in percentages that make your head spin. And that's where the first cliffhanger hits, because the real story isn't the move to 90 on the dollar index. The real story is what happens if 90 doesn't hold. Because 90 is not just another number. It's the point where, if it breaks, the conversation shifts from temporary weakness to structural change. And that's when the psychology changes for everyone. Savers, institutions, central banks, even regular people who don't care about markets until grocery bills start shouting at them. So let's talk about the path below 90. And before you assume this is only about the US, zoom out for a second. The same debt math is haunting other major currencies too. Look at the euro area, a shared currency with very different fiscal realities underneath it. Some members can handle higher rates, others can't. That's why you keep seeing periodic stress in sovereign spreads and emergency-sounding language when borrowing costs rise. When the market starts pricing fragmentation risk, it changes how global investors think about holding that currency long term. Look at the UK, a country with deep markets and strong institutions, but also a history of getting punished when fiscal promises collide with bond market reality. The pound has had moments where it moved like an emerging market currency, and that should tell you something. Confidence can be lost faster than it's built. And look at Japan. Enormous debt, a population dynamic that isn't getting easier, and a bond market that has been held together for years by policy choices that can't run forever without side effects. When yields finally move, even a little, global money has to reprice the entire carry trade structure that depended on low Japanese yields. That's one reason you've seen the yen become a pressure point in global markets. So the reason I'm bringing up the euro, the pound, and the yen is not to say they're doomed. It's to make one point. The world doesn't have an obvious, painless escape hatch. If multiple currencies are strained at the same time, capital doesn't just choose the least bad paper. It starts choosing assets that sit outside the paper game. That's where gold has always lived. And that's why silver has started acting like it wants a seat at that table too. Now here's the cliffhanger within the cliffhanger. When capital starts moving into metals for monetary reasons, at the same time industrial users keep buying silver for real-world production, the two demand streams can stack on top of each other. And when that happens, price action gets weird, fast. So keep that image in your head as we talk about what happens below 90, because the next chapter is not just a chart level, it's a behavioral shift. And I want you to stay with me here because this is where the script flips. If the dollar index falls into the high 80s, the dollar still exists, obviously. The world doesn't end. Your card still works. Your paycheck still hits. But the dollar becomes less trusted at the margin. And at the margin is where markets move. Then, if the dollar index slides into the 70s again, like it did in the early 2010s, it doesn't mean America is finished. It means the price of everything else, measured in dollars, has to adjust. Oil, food, metals, imports, travel. You don't need a dystopian movie. You just need arithmetic. And yes, people love to jump straight to the scary stuff. They're going to ban gold. They'll confiscate silver. They'll kick down doors. Slow down. History usually doesn't start with soldiers. It starts with incentives, rules, and pressure. In some countries, when the currency starts bleeding, the first stage looks deceptively normal.
Shops open, restaurants are full, tourists take photos, and the skyline still glows at night. But behind the